Investing is important. It helps your money grow over time. This is called compounding. When you invest, your money earns more money. Then, that earned money earns even more. It's like a snowball effect. Investing helps you reach your financial goals. You can save for retirement, a down payment, or education. Don't wait. The sooner you start, the more time your money has to grow. Investing means putting your money to work. Instead of letting your money sit idle in a savings account, you can use it to buy assets that have the potential to grow in value over time. This way, your money can generate more money, creating wealth for you in the long run. The key is to understand the different types of investments available and how they work. You buy assets that you hope will increase in value. These assets can be anything from stocks and bonds to real estate and mutual funds. Each type of investment has its own characteristics, benefits, and risks. By diversifying your investments, you can spread out your risk and increase your chances of achieving your financial goals. There are different types of investments. Stocks, bonds, real estate, and mutual funds are some of the most common options. Each type of investment offers different opportunities and challenges. Understanding these differences is crucial for making informed investment decisions. Stocks represent ownership in a company. When you buy a stock, you become a shareholder, which means you own a part of that company. Stocks can offer high returns, but they also come with higher risks. The value of stocks can fluctuate based on the company's performance and market conditions. Bonds are like loans you give to the government or companies. In return, they promise to pay you back with interest over a specified period. Bonds are generally considered safer than stocks, but they usually offer lower returns. They can be a good option for conservative investors looking for steady income. Mutual funds are baskets of stocks or bonds. When you invest in a mutual fund, your money is pooled together with other investors' money to buy a diversified portfolio of assets. This diversification can help reduce risk and provide more stable returns. Mutual funds are managed by professional fund managers who make investment decisions on behalf of the investors. Each investment has a different level of risk. Risk is the possibility that you could lose some or all of your investment. Understanding the risk associated with each type of investment is essential for making informed decisions. Some investments, like stocks, have higher risk but also the potential for higher returns. Others, like bonds, have lower risk but also lower returns. Risk is the chance you could lose money. It's important to assess your risk tolerance before making any investment. Your risk tolerance is your ability and willingness to endure market fluctuations. If you have a high risk tolerance, you might be comfortable with more volatile investments. If you have a low risk tolerance, you might prefer more stable investments. Higher risk investments have the potential for higher returns. This means that while you could make a lot of money, you could also lose a lot. It's a trade-off that every investor must consider. Balancing risk and reward is a key part of successful investing, but they are also more likely to lose value. High-risk investments can be very volatile, meaning their value can change rapidly and unpredictably. This can lead to significant financial losses if the market moves against you. It's important to have a well-thought-out investment strategy and to be prepared for the ups and downs of the market. Opening an investment account is easy. You can open an account online or with a brokerage firm. First, choose a reputable brokerage firm. Consider fees and the types of investments they offer. Next, gather your personal information. You'll need your social security number and bank account details, then fill out the application form, answer all questions honestly and accurately. Finally, fund your account to start investing. When you buy a stock, you buy a small piece of a company. You become a shareholder. This means you own a fraction of the company, no matter how small. Your ownership stake represents a claim on part of the company's assets and earnings. Essentially, you are now a part owner of the business, and your fortunes are tied to its performance. Companies sell stock to raise money. This process is often initiated through an initial public offering, or IPO, where shares are offered to the public for the first time. By selling shares, companies can access a large pool of capital that can be used for various purposes. This influx of funds can be crucial for a company's growth and expansion plans. They use the money to grow their business. This could mean expanding their operations, launching new products, or entering new markets. The capital raised from selling stock can also be used to pay off debt, invest in research and development, or improve infrastructure. Essentially, the money helps the company to scale and enhance its competitive edge. As a shareholder, you can profit in two ways. The first way is through capital appreciation. This occurs when the stock price increases over time. If the company performs well and its value grows, the price of its stock typically rises. This means that the shares you own become more valuable. First, the stock price can go up. When this happens, the value of your investment increases. If you decide to sell your shares at this higher price, you can realize a profit. This is one of the primary ways investors make money in the stock market. You can sell your shares for a profit. Timing is crucial here, as selling at the right moment can maximize your returns. However, it's important to remember that stock prices can be volatile, and predicting the perfect time to sell can be challenging. Second, companies can pay dividends to shareholders. Dividends are typically paid out of the company's profits and are distributed on a regular basis, such as quarterly or annually. These payments provide a steady income stream for investors, in addition to any potential gains from selling the stock. Dividends are a share of the company's profits. They are a way for the company to reward its shareholders for their investment. Not all companies pay dividends, but those that do often attract investors looking for regular income. The amount of the dividend can vary based on the company's performance and profitability. Investing in stocks can be risky. Stock prices can fluctuate widely due to various factors, including market conditions, economic indicators, and company-specific news. This volatility means that the value of your investment can go down as well as up. It's important to be aware of these risks and to invest wisely, but it also offers the potential for high returns. Historically, stocks have provided higher returns compared to other types of investments such as bonds or savings accounts. This potential for growth makes stocks an attractive option for many investors, especially those willing to take on a higher level of risk for the chance of greater rewards. Section 5. Bonds, lending for a return. Bonds are different than stocks. When you buy a bond, you are lending money. You lend money to a government or company. They agree to pay you back with interest. Bonds are generally less risky than stocks. They offer a fixed rate of return. This means you know how much interest you will earn. Bonds are a good addition to a diversified portfolio. They provide stability and income. Section 6. Mutual funds, investing in a basket of assets. Mutual funds are a popular investment option that allows you to invest in a diversified portfolio. But what exactly does that mean, and why should you consider it? Mutual funds pool money from many investors to invest in a variety of assets, such as stocks, bonds, and other securities. This pooling of resources allows individual investors to access a broader range of investments than they might be able to on their own. By investing in a mutual fund, you are essentially buying a small piece of a large, diversified portfolio. This diversification helps to spread risk because the performance of the fund is not tied to a single investment. Instead, it reflects the performance of all the assets within the fund. One of the key benefits of mutual funds is that they are managed by professional fund managers. These experts analyze market trends, economic data, and individual securities to make informed investment decisions on behalf of the fund's investors. This professional management can be particularly beneficial for new investors or those who do not have the time or expertise to manage their own investment portfolios. Fund managers aim to achieve the best possible returns while managing risk. Mutual funds come in various types, each with its own investment strategy and risk profile. Some funds focus on growth by investing in stocks, while others may prioritize income by investing in bonds or other fixed income securities. There are also balanced funds that aim to provide a mix of growth and income. When choosing a mutual fund, it's important to consider your own investment goals, risk tolerance, and time horizon. Reading the fund's prospectus can provide valuable information about its objectives, strategies, and past performance. Additionally, mutual funds charge fees for their management and operation. These fees can vary widely, so it's crucial to understand the cost structure of any fund you are considering. Lower fees can help improve your overall returns over time. In summary, mutual funds offer a convenient way to invest in a diversified portfolio with professional management. They can be a valuable tool for both new and experienced investors looking to achieve their financial goals. By understanding how mutual funds work and carefully selecting the right ones for your needs, you can make informed investment decisions that align with your objectives. Section 7. Don't put all your eggs in one basket. Diversification. Diversification is crucial for any investor. It means spreading your money across different assets. Don't put all your eggs in one basket. If one investment performs poorly, others can cushion the fall. Diversify across different asset classes. Invest in stocks, bonds, and real estate. Also diversify within asset classes. For example, invest in different sectors within the stock market. Section 8. Rookie mistakes and how to avoid them. Beginners often make common investing mistakes. It's important to be aware of these pitfalls. One mistake is investing based on emotions. Don't panic sell when the market drops. Another mistake is not investing for the long term. Investing is a marathon, not a sprint. Finally, avoid chasing hot stocks or following the crowd. Do your own research and invest in quality companies. Section 9. Start investing today. Secure your future. Investing is essential for financial well-being. It allows you to grow your money and achieve your goals. Start small and gradually increase your investments over time. Remember, time is your greatest ally in investing. The sooner you begin, the more time your money has to compound. Don't wait for the perfect time to start. Take the first step towards securing your financial future. Start investing today.
Thank you for watching. Please support us by liking this video and subscribing to our channel.